If you're worried about these high interest rates and you're looking for a way to get your monthly payment down, I'm going to share with you the strategy that I use for home buyers that I've seen work time and time again. With a rate buy down, you can get a much lower rate. And I'm not talking about just a little bit cheaper. We're talking 2 or 3% lower without having to pay for it yourself. I'm going to show you 3 different options for rate buy downs that can help you win in this market. So we all know that the housing market is cooling off in the buyer's favor. The good news is there's more inventory out there right now. We're starting to see more inventory hit the market and it's sitting a bit longer. So it's giving buyers better opportunities to find a house that they really like and also negotiate for a great deal. The bad news is interest rates have been rising and we're seeing rates sitting around the 6 to 7% range. Obviously, higher interest rates leads to higher monthly payments. So everybody's concern out there right now with high interest rates is, can you afford the monthly payment? But I'm going to show you 3 different options that can get you a lower interest rate than what the market is currently offering and making your payment a lot more affordable. Strategy number 1 is a permanent interest rate buy down. This is the one that most people are familiar with. So interest rates come in 3 forms. The natural rate or the par rate is what you actually qualify for. Then you have premium rates. So premium rates are taking a rate that is higher than what you qualify for, but the lender is going to give you a credit back that you could use towards closing costs. So basically the lender is paying you to take a higher interest rate. Then you have discounted rates. This is where you're taking a rate that's lower than what the market currently offers, but it's going to cost you money. So the permanent buy down hasn't really been very popular over the last few years, specifically during the COVID era. When we were seeing rates in the 2 or 3% range, it just didn't make a whole lot of sense to buy down your rate. But in today's market, if you can get the seller to pay for your buy down, then this could be a great strategy. Let's look at an example. Let's say that you're buying a $500,000 house and the current market rate is 7.5%. People are saying, man, that's way too high. I don't want that. That's going to make my payment too high. So let's say that the client's ideal rate or target rate is 5.5%. So buying a $500,000 house, current market rate is 7.5%, but you really need it to be around the 5.5% to make it affordable. So what we can do is a permanent interest rate buy down. So here's how it works. So I'll run a total cost analysis for you and figure out how much it would cost to get your rate from 7.5% down to 5.5%. Let's say hypothetically it costs $25,000. So then you and your realtor can go back to the homeowner or the listing agent and say, hey, happy to give you $500,000 for the house, but I'm going to need a $25,000 seller credit. So we can use that $25,000 seller credit to buy down your interest rate from 7.5% down to 5.5%. It's going to save you over $400 a month. So instead of taking the concession off the price of the house and buying the house for $25,000 less, using that $25,000 for an interest rate buy down is going to get you a lot lower payment than that lower purchase price would. So that's option 1, a permanent interest rate buy down. Now number 2 and 3 are what's called temporary buy downs. So I'll start with the 2-1 buy down. The 2-1 buy down will allow you to have a 2% lower interest rate for the first year, a 1% lower interest rate for the second year, and then from year 3 to the end of the loan term, it will remain fixed at whatever the current market rate is. So right now, if the market rate is 7.5%, for example, then year 1, your interest rate would be 5.5%, year 2, 6.5%, and then from years 3 to the end of the loan term, it'll be fixed at 7.5%. So why would you choose a temporary buy down over a permanent buy down? So for starters, it would be cost. It can be a lot more expensive to do a permanent buy down, sometimes even double the cost as a temporary buy down. You might be thinking, well, I don't want my interest rate just at 5.5% for 1 year. Here's a few things to consider. Number 1 is a lot of people are going to refinance in the next 12 to 24 months. So if rates drop from the 7% range down to the 5 or 6% range, most people are going to refinance down to that lower rate anyways. So you might not keep the loan long enough to justify a permanent interest rate buy down. Another big benefit of doing a 2-1 buy down is the money that's used to do the buy down is held by the mortgage company. So when you get that money from the seller for the temporary buy down, it's held in escrow. Some of the money is used for the first year to buy down the rate, and the rest of the money is used the second year to buy down the rate. This means if you decide to sell, refinance, or pay off the property in the next 1 to 2 years, any money that hasn't been used for the temporary buy down will be returned to you. So if you decide to refinance in a year and a portion of the funds for the buy down are left over, that money will be credited back to you. So if you want a lower interest rate for the first 2 years, but you don't want to pay as much for a permanent buy down, then the 2-1 temporary buy down could be the option for you. But just keep in mind, after that 2-year period, you have to make the decision if you want to refinance if the rates are lower or keep that same payment. All right, so option number 3 is a 3-2-1 temporary buy down. It's very similar to the 2-1 buy down. Instead of buying it down 2% the first year, 1% the second year, it will be 3% for the first year, 2% the second year, 1% for the third year, and then from years 4 to the end of the note term, it'll be at whatever the market rate is. So using that same example, we'll say the current market rate is 7.5%. Your first year, you would have a 4.5% rate, second year, 5.5%, third year 6.5%, and then from years 4 to the end of the note term, it would go back to the market rate of 7.5%. So it's basically the same thing as a 2-1 buy down. It's a little bit more aggressive, but if you're looking to save more money on interest in the short term, this could be the option for you. Now, looking at the 2-1 versus a 3-2-1 buy down, the biggest difference is going to be cost. It's going to cost a lot more to get the 3-2-1 than it is the 2-1 buy down. And that's something we can discuss with the realtor to figure out how much we think you can get from the seller. Ultimately, which option you choose depends on how much money you negotiate from the seller. If you get a little bit of money, then maybe the 2-1 buy down makes the most sense. If you get a lot of money from the seller, maybe the 3-2-1 buy down makes sense. And we can always compare those options with the permanent buy down, which will keep your rate low for the life of the loan. And there's a lot of other factors that go into which option is the best move for you. There's a lot of questions to be answered, like how long will you have the loan? How long will you live in the property? What is the market going to do in the future? And where do we think values are going to be at? There's a lot of factors that go into making this decision. This is how we can help you decide for your specific situation, which option makes the most sense for you. All right, so we've looked at a bunch of different options, a bunch of different scenarios, but it all boils down to you can get a lower interest rate than what the market is currently offering, which will ultimately get you a lower payment. But here's the thing, it doesn't make sense for you as the buyer to pay for it. If you can negotiate for the seller to pay for it, then they're the ones incurring all the costs. They're the ones using their money to buy down the rate. So what does this all mean for you? Well, you get the house you love, you get your offer accepted, you get the lower interest rate that's going to keep your monthly payment at an affordable level, but the seller also wins because the seller might not have to reduce their purchase price as much, and they'll likely get their house sold quicker using one of these strategies. So everybody's happy, it's a win-win. But if you want to learn the #1 tip for buying a home in 2023, then you need to watch this video next. Link in the description.